What if I told you that one of the safest, most profitable ways to invest in the high-risk electric vehicle boom and, the volatile semiconductor supercycle isn't by gambling on some Silicon Valley startup?
Right, which is what everyone usually tries to do.
Exactly. But what if it's actually by buying a 100-year-old industrial company based in Illinois? A company that literally makes welding gear and commercial dishwashers.
It sounds a bit crazy when you put it like that.
It really does. But welcome to the deep dive. Today, we are tearing apart the Q2 2026 earnings call for Illinois Toolworks. That's ticker symbol ITW for you Talk Tickers listeners.
Yeah, this is a fascinating one to dig into.
We are looking at a very traditional conglomerate that is, quite frankly, fundamentally rewiring what it means to be a modern industrial powerhouse.
And we really want to break down those top and bottom lines for you. We need to dissect the internal strategies driving their growth.
Right, and figure out what management is telegraphing about the future. Because by the end of this deep dive, our mission is to give you, the retail investor, a very clear, opinionated take on what to do with this stock.
And honestly, looking at the raw data from this earnings call, that whole stealth tech play thesis that you just mentioned, it's actually totally supported by the numbers.
Really? Even for a company making dishwashers?
Yeah, when we evaluate an industrial giant like ITW, the main challenge is cutting through the incredibly dry, highly technical corporate language.
Oh, the jargon is always so thick with these legacy companies.
It's so dense. Management teams in this sector, they don't speak in hype. They aren't getting on the call and hyping up AI or whatever. They speak in, basis points, organic growth metrics, and capital expenditure cycles.
Which can put a regular investor right to sleep.
Exactly.
Yeah.
But beneath all that jargon, they're often describing massive strategic shifts. So my whole focus today is to help you decode that language.
We really need to determine if ITW is genuinely generating its own weather through operational excellence, or, if they just happen to have their sails up while the global macroeconomic tailwinds are blowing in their favor.
Right. Are they lucky or are they good? So let's start with the baseline reality of their second quarter. We need to establish the raw data before we can really dissect how they achieved it.
Let's do it. The top line revenue results for Q2 are, frankly, eye-popping for a mature industrial company. Total revenue grew 6.1%.
That is a very solid headline number.
It is, but within that headline number, 4.5% was purely organic growth.
And that is the number that actually matters.
Yeah, they completely stripped out any illusions created by acquisitions or currency fluctuations to arrive at that 4.5% figure.
And for you listening, that distinction between total revenue and organic growth is it's one of the most critical metrics you can monitor as an investor.
Why is that so crucial for a company like ITW?
Well, it is very easy for a massive multinational conglomerate to just buy top-line growth.
Right, they just open the checkbook.
Exactly. They could acquire a smaller competitor, slap those new sales onto their own income statement, and suddenly their revenue looks like it's surging.
But the core business might actually be stagnant.
Precisely. Or they can get lucky with foreign exchange rates. Like, if the US dollar weakens against the euro, the sales ITW makes in Germany suddenly translate back into way more dollars.
So it artificially inflates the top line without them actually selling more widgets.
You got it. And the remaining 1.6% of ITW's total revenue growth actually came from those exact factors.
Let's break that 1.6% down then.
So it was a 1.4% contribution from foreign currency translation and a tiny, 0.2% bump from a small acquisition.
Which means when Wall Street analysts are building their financial models for a company like this, they're just throwing out the 6.1%.
Well, absolutely. They toss it out and fixate entirely on that 4.5% organic number.
Because that 4.5% represents the core underlying heartbeat of customer demand, right?
Yes. It tells you that if you strip away all the financial engineering and the exchange rate luck, the actual volume of products moving out of their factories grew.
The volume and the price they are commanding for those products grew by 4.5%.
Right. And for a multi-billion-dollar industrial heavyweight, generating that level of pure organic demand in the current economic environment is highly impressive.
And the bottom line is where the story gets even more compelling. GAAP earnings per share, or EPS, shot up 10% to $2.84.
A very strong beat.
But here is the historical milestone that I really want to frame for you. Their operating income reached $1.15 billion.
Which is just a staggering amount of cash.
It is. That is a 7.4% year-over-year increase. But this wasn't just a solid quarter. This was the single most profitable quarter in ITW's entire 100-plus year corporate history.
Let that sink in for a second. More than a century of operations, and this is their peak profit.
Right. In a macro environment where everyone is worried about inflation, supply chain hangovers, and, consumer spending shifts, breaking an all-time historical profitability record is a massive signal.
It is a definitive statement of pricing power and internal control. But you have to look at how they actually reached that $1.15 billion milestone.
It wasn't just by brute forcing more volume through the factories, was it?
No, not at all. It was achieved through ruthless operational efficiency. Their operating margin expanded to 26.7%.
Okay, 26.7%.
Yeah, which is a 40 basis point increase over the previous year.
Let's contextualize that margin for you. A 26.7% operating margin means that for every single dollar of revenue that comes in the door, ITW is keeping almost 27 cents in pure operating profit.
Right, and that's after paying for all the raw materials, the factory labor, research and development, and the corporate overhead.
In the software industry, you might see margins like that all the time.
Oh, sure. Building an app is basically zero marginal cost.
Exactly. But in the heady industrial sector, where you are physically bending metal, pouring specialized chemicals, and shipping 1,000-pound pieces of equipment around the world, pushing your operating margin north of 26% is incredibly difficult.
It's almost unheard of for a company with this kind of physical footprint. And a massive chunk of this margin expansion came directly from what management vaguely refers to on the call as enterprise initiatives.
Enterprise initiatives, that sounds like peak corporate jargon.
It really does. It sounds like a buzzword from a consulting firm.
So what does an enterprise initiative actually look like on the factory floor?
Think of it like pruning a massive overgrown oak tree.
Okay, I like this analogy. Walk me through it.
If a tree has hundreds of branches, some are producing incredible amounts of foliage and acorns, right? But others are dead, diseased, or maybe they're just completely blocking the sunlight.
So the tree is expending huge amounts of water and nutrients just to keep those inefficient branches alive.
Exactly. Enterprise initiatives are the corporate equivalent of a highly aggressive pruning strategy. ITW is actively cutting off the dead branches.
What are the dead branches in this scenario?
Well, they are consolidating redundant manufacturing facilities, for one. They are also simplifying their supply chains so they can buy raw materials more efficiently.
And I imagine they are just killing off product lines that don't make sense anymore.
Yes, they are aggressively eliminating low-margin, overly complex product lines that just aren't worth the headache. By doing that, all the nutrients, meaning the capital, the engineering talent, the factory floor space, flow directly to the healthiest branches.
So they yield exponentially more fruit from the exact same trunk.
Right. They aren't just trying to water the whole tree more, they are reshaping the tree entirely.
So they aren't just selling more products. They have fundamentally redesigned the business to require fewer resources to grow. That is a great way to visualize it.
And when you pair that heavily pruned, highly efficient tree with a 4.5% organic increase in the amount of water and sunlight hitting it, you get the most profitable quarter in the company's history.
It makes perfect mathematical sense when you lay it out like that.
Furthermore, to really understand the velocity of this growth, you have to look at their sequential trajectory, not just the year-over-year numbers.
Right. How did Q2 compare to Q1 of this same year?
Management noted that moving from Q1 to Q2 of this year, their sequential revenue growth was 7%.
Okay, 7%. Is that unusual for them?
Yes. Historically, if you look back over the last decade, their average sequential growth from a Q1 to a Q2 is only 2%.
Wow, so 7% is a massive divergence from their historical baseline.
It really is. It shows that the acceleration in demand really gained structural momentum as the quarter actually went on.
It wasn't just one big lucky order in April that carried the whole quarter.
No. Management explicitly pointed out that April started well, May sustained that momentum, and June was even stronger.
That's the kind of ramp up you want to see.
Exactly. This isn't a company coasting on a single large contract. This is a broad-based acceleration across the timeline of the quarter.
So we have established the baseline reality here. They broke all-time profitability records, their margins are expanding, and their sequential growth is defying historical gravity.
A very strong foundation to build an investment thesis on.
But if we're going to understand why this is happening, we really need to look under the hood. ITW is a highly diversified conglomerate. They operate in 7 distinct segments.
Right. They do a little bit of everything in the industrial space.
So where exactly is this massive growth actually coming from?
The growth is heavily concentrated in their capital expenditure or CapEx-related businesses.
Meaning things other companies buy to build their own products.
Yes, we are seeing immense strength in 3 specific areas that cater to heavy industrial investments rather than just consumer discretionary spending.
Okay, let's list those 3 out.
First, the welding segment skyrocketed by 14% organically.
14% for welding, wow.
Second, the test and measurement segment surged by 10%. And third, the polymers and fluid segment jumped by 7%.
Okay, I have to push back here on behalf of the listener, especially regarding that welding number.
I figured you might. It sounds almost too high.
It does. When I see a 14% jump in something as traditional as welding equipment, and specifically, the call noted that equipment sales alone surged 19%, my immediate, highly skeptical thought is, isn't this just a post-pandemic cyclical bounce?
That is the exact right question to ask.
Because we know supply chains were severely kinked for years. Is this just a scenario where a bunch of manufacturing plants are finally, replacing the old welding rigs they just couldn't get their hands on in 2023 or 2024?
Right, playing catch up.
Because if it is just catch up, that is a temporary spike. It is not a sustainable growth trend that warrants a premium stock valuation.
And honestly, that was the primary focus during the Q&A portion of the earnings call. Multiple Wall Street analysts drilled down on that exact point.
Good. So I'm not the only skeptical one. What did management say?
Well, they needed to answer whether this durability is real or if it's just a mirage created by supply chain normalization. And management's response to this skepticism introduces us to the true internal engine of ITW.
Which is what?
Something they call CBI, which stands for Customer-Backed Innovation.
Customer-backed innovation.
Okay, but before we even get to the innovation piece, their first defense against the cyclical bounce argument is their actual order book.
The orders they haven't fulfilled yet.
Yes. The leadership team stated that the order intake in the welding segment is actually running ahead of that 14% revenue growth rate.
Wait, really? Meaning they are still booking new orders faster than they can ship the old ones out the door?
Exactly. They are building a highly profitable backlog.
Which gives them a massive runway of guaranteed revenue for the next several quarters.
Right. The demand isn't softening. It's actively compounding. But the true sustainable engine driving this, the reason customers are ordering so aggressively in the first place, is CBI.
Let's unpack the CBI metric for you, because if you are going to invest in ITW, this is basically the single most important acronym you need to understand.
It really is the key to their future growth.
CBI contributed a massive 3% to their total organic growth in the first half of the year.
Which is huge when you consider their total organic growth was 4.5%.
Now, you might hear a phrase like 3% growth from innovation. I think it just sounds like a nice marketing slogan, something a PR team cooked up.
Oh, absolutely. It sounds incredibly fluffy.
But this is a hard, audited financial metric for them, isn't it?
Yes, it is heavily tracked internally. And the most crucial detail is that management strictly strips out cannibalization when calculating this number.
That cannibalization caveat is what makes CBI so powerful. Let me give you a hypothetical. Let's say ITW introduces a brand new, highly advanced robotic welding cell for a Ford assembly line.
Okay, good example.
If Ford buys that new robotic cell instead of buying ITW's older manual welding model, that is just cannibalized revenue.
Right, because ITW didn't actually grow its total sales in that exchange.
Exactly. It just swapped an old product for a new one. The money shifted from one bucket to another, so that revenue does not count toward the CBI metric at all.
It's just treading water, financially speaking.
So it does count.
The CBI metric only measures true, incremental, entirely new revenue generated by these innovations.
Meaning revenue that solves a brand new problem and captures new capital from the customer.
Exactly. So when ITW says CBI drove 3% growth, that is entirely fresh cash coming into the business that literally would not have existed without their recent research and development efforts.
They aren't just selling the same old widgets or even slightly upgraded widgets. They are identifying totally unsolved friction points for their customers and engineering entirely new solutions.
Solutions that open up completely new revenue streams for ITW. And what's wild is that management originally set a long-term target of 2 to 3% growth, driven purely by CBI.
And where are they at now?
Well, halfway through 2026, they are already hitting that top-end 3% mark.
That is incredibly fast execution.
It is. The CEO mentioned on the call that they codified this whole customer-backed innovation framework late in 2024.
So it's a relatively new corporate structure for them.
Yeah, they mapped out exactly how they wanted to interact with customers, how they wanted to structure their R&D, and they have been relentlessly implementing it across all 7 divisions.
He even compared their current obsession with CBI to their historical obsession with their famous 80/20 business model, right?
He did, and that comparison is not made lightly within the halls of ITW.
No, I imagine not.
The 80/20 model is basically the foundational bedrock of the company. It's the operational religion that took them from a standard manufacturer to a high-margin compounding machine over the last 2 decades.
Since you brought it up, we really need to actually define the 80/20 model for you. Because if you don't understand 80/20, you honestly just don't understand ITW.
It's the lens through which they view everything.
It is based on the Pareto principle, the idea that in almost any business, 80% of your profits come from just 20% of your customers, or 20% of your product lines.
And conversely, the remaining 80% of your customers or products only generate 20% of the profit.
But they are a massive headache.
Right. They consume a massive, disproportionate amount of your time, your factory floor space, your supply chain logistics, and your overhead.
Most companies are terrified to let go of that bottom 80% because it represents top-line revenue.
Even if it's barely profitable, CEOs love to brag about top-line revenue.
Exactly. If a CEO willingly shrinks top-line revenue by dropping customers, Wall Street usually panics.
They assume the company is failing.
But ITW's 80/20 model is a strict, highly disciplined framework where they aggressively identify their most critical, highest volume, highest margin customers.
That vital 20%.
Right. And they disproportionately focus all their engineering and manufacturing resources on serving them perfectly.
Meanwhile, they systematically simplify, outprice, or just outright shed the bottom 80% of the noise.
They just stop making the low-margin custom widgets for tiny clients that clog up the manufacturing lines.
And by doing this, their top-line revenue might look stagnant for a period, but their operating margins explode upward, just like the pruning analogy we discussed earlier.
So when the CEO compares their new CBI innovation framework to their legacy 80/20 model, he is making a very bold statement.
He is essentially saying, we revolutionized our profit margins 20 years ago with 80/20. Now we're going to revolutionize our top-line organic growth with CBI.
And to make sure everyone in the company actually executes this, they tied the compensation structure to it, didn't they?
Which is the ultimate lie detector for any corporate strategy.
Oh, absolutely. If you want to know what a company truly values, ignore the press releases and look at how they pay their executives.
Exactly. ITW ties divisional and executive compensation directly to hitting these specific, non-cannibalized CBI metrics.
That is ruthless.
It is. They're forcing the entire organization to either generate purely incremental revenue from new products or, well, miss their bonuses.
You align the incentives, you get the results.
And this focus on solving specific high-value customer problems flows directly into the margins too.
Because these new products under the CBI umbrella are highly differentiated.
Right, meaning no competitor makes anything exactly like it. So ITW has immense pricing power.
They aren't competing on price, they're competing on the value of the solution.
So these new products are coming in at significantly higher profit margins than the legacy portfolio, which is just another reason that operating margin ticked up to 26.7%.
And this brings us right back to your opening premise about the stealth tech play.
Yes, the application of this CBI engine is what is driving the massive surges in specific subsegments that are tied to futuristic macro trends.
Let's get specific here. Look at the test and measurement segment.
Right, so that segment grew 10% overall. But within that segment, the electronics and semiconductor division surged by 21%.
21%. How does a Midwestern tool company end up riding a 21% surge in semiconductor growth? What are they actually selling to these tech companies?
They're selling the highly specialized testing equipment and clean room materials required to manufacture microchips.
So they aren't making the chips themselves.
No, but semiconductor fabrication is incredibly precise. A microscopic flaw ruins the entire chip. ITW designs the systems that test the structural integrity and performance of these electronics right on the assembly line.
And the semiconductor industry went through a pretty severe down cycle over the last 2 years, right? As supply chains got glutted.
They did, but now with the explosion of advanced computing, AI data centers, and the massive electronic architecture required for modern vehicles, the semiconductor cycle is violently ramping back up.
And ITW positioned their test and measurement segment perfectly to capture that ramp up.
Exactly. They provided the picks and shovels for the semiconductor gold rush.
And we see a very similar dynamic in the polymers and fluids segment, which jumped 7%.
Again, it sounds so boring.
Yeah.
Polymers.
It sounds like chemistry class. But when you look at what is driving that growth, it is heavily indexed to the automotive industry, and specifically the transition to electric vehicles.
This is a huge shift. An internal combustion engine vehicle requires a very specific set of fluids, sealants, and thermal adhesives.
Right. Stuff for the gas tank, the engine block, the radiator.
But an electric vehicle requires an entirely different, vastly more complex set of thermal management polymers.
To keep the massive battery arrays from overheating, I assume.
Exactly, to manage battery heat, to seal the electronic control units, and to bond lightweight composite materials together safely.
And ITW's automotive divisions have aggressively engineered new polymers specifically for this EV market.
In fact, management noted that global EV production is now almost 20% of the overall automotive market.
That is a staggering market share.
And this is driving immense growth, specifically in ITW's Chinese divisions.
Let's focus on that China detail for a moment, because it is crucial to understanding their global strategy. The Chinese EV market is moving at a breakneck pace, significantly faster than the US or European markets.
They are iterating on vehicle designs in months, not years.
And ITW is deeply penetrated within that local Chinese EV manufacturing ecosystem.
Because they operate with a highly decentralized structure. Their Chinese divisions are fully empowered to innovate and deploy these new CBI-driven thermal polymers directly to the local EV manufacturers.
So they don't have to wait for 6 layers of corporate approval from headquarters in Illinois.
Right. They can move as fast as their clients. They are matching the speed of the fastest-moving automotive market in the world, supplying the vital chemical architecture that makes these EVs safe and efficient.
This is the absolute core of the stealth tech thesis. You don't have to pick which Chinese EV startup is going to survive the brutal price wars over there.
Which is basically impossible to predict anyway.
Exactly. You just buy the company that supplies the highly specialized thermal adhesives to all of them.
It's a brilliant backdoor play.
Okay, so the growth story is incredible. Welding up 14% on the back of industrial automation. Electronics within test and measurement surging 21% on the semiconductor rebound. And specialized EV polymers driving growth in China.
The top-line health is undeniable.
But I want to pivot here and look at the hidden headwind in this report, because if you read the transcript closely, it wasn't a completely frictionless quarter.
Far from it, actually.
You mentioned earlier that their operating margins expanded by 40 basis points to a record 26.7%. But the reality is, this record profit happened despite a significant inflationary anchor dragging them down.
That is a critical observation for investors to make. The margin expansion could have, and frankly should have, been much higher.
Wait, higher than 26.7%?
Yes. ITW actually took a temporary 40 basis point hit, a direct dilution to their margins because of what is known in the manufacturing sector as a price-cost timing lag.
Let's explain the mechanics of a price-cost lag for you.
Yeah.
It really all comes down to the speed at which money moves through a massive supply chain.
Right, the inputs versus the outputs.
The raw materials ITW needs to build their products, specifically crude oil derivatives that are used to make those resins, and specialized EV polymers we just talked about, all experienced a sudden inflationary spike in the first half of the year.
As well as electronic components for the testing equipment and just general global freight costs.
Exactly. When the price of crude oil goes up, the chemical companies that supply ITW immediately raise the price of resins.
And those rising costs hit ITW's accounting books the exact moment they purchase the raw materials.
So the cost of goods sold instantly increases, which immediately compresses their profit margins.
However, ITW cannot instantly pass those higher costs onto their own customers.
Right. If ITW has a multi-year contract with a massive automotive OEM like Ford or Toyota to supply polymers, they can't just call up the purchasing manager every Tuesday and say, hey, the price of crude oil ticked up 3% yesterday, so your invoice is higher today.
Ford would laugh them off the phone.
Oh.
There are contractual notice periods. There are intense negotiations.
So there is an inherent structural lag built into the system.
Yes. So for a period of roughly 3 to 6 months, ITW is essentially forced to absorb that higher raw material cost while still selling their finished products at the old lower prices.
They're just squeezed in the middle.
If it wasn't for this temporary timing lag, management explicitly noted that their margin expansion wouldn't have been 40 basis points. It would have been a staggering 80 basis points.
Wow. And this highlights perhaps the most profound underlying strength of the entire business. They absorbed a significant, unexpected inflationary hit on their core raw materials. They suffered a temporary margin squeeze. And they still posted the single most profitable quarter in their entire corporate history.
It demonstrates extraordinary resilience. They've built a machine that can take a punch and keep running.
But the reason this is so exciting for investors looking forward is that the timing lag is exactly that temporary.
Yes, management noted on the call that the input costs for resins and crude oil derivatives are already starting to plateau and even trend downward as we enter Q3.
Meanwhile, the delayed price increases that ITW aggressively pushed through to their own customers months ago are finally taking effect.
The contracts have officially caught up.
The math is about to aggressively flip in their favor. The input costs are dropping while their selling prices are rising.
And this dynamic creates a massive tailwind for profitability in the back half of the year.
So the squeeze is over and the expansion begins.
Exactly. The CFO mentioned that because of this reversal, their implied incremental margin guidance for the full year is 40%.
If there is a single financial concept to take away from this deep dive, it is incremental margin. Let's define this clearly, because a 40% incremental margin is basically the holy grail for an industrial stock.
It's a massive number.
If ITW's incremental margin is 40%, it means that for every single new dollar of revenue they generate above their previous baseline, 40 cents of that new dollar falls straight to the bottom line as pure operating profit.
It is a staggering level of operational leverage.
When you combine their pruned, highly efficient 80-20 cost structure with the catch-up in pricing, the flow-through of new revenue to net income is just incredibly powerful.
And if you connect this to the bigger picture of their long-term strategic goals, management is targeting a 30% total enterprise operating margin by the year 2030.
Which is only a few years away at this point.
Right. And some of their divisions are already there. 3 of their 7 segments, welding, food equipment, and construction, are already operating at or near that 30% margin mark.
Wait, welding is at 30%.
Better than that. Welding, despite being a heavy industrial product line, is sitting at an incredible 32.4% operating margin.
That's just absurd for bending metal and making electrical arcs.
During the Q&A, an analyst specifically asked if they were hitting a natural ceiling in the welding segment.
Basically saying you can't possibly squeeze any more profit out of a welding machine, right?
Exactly. But management flatly rejected that idea. Because of the relentless, ongoing application of the 80-20 business model, constantly finding new inefficiencies to eliminate, and the upcoming reversal of that price-cost lag, they expect margins across all segments, including welding, to continue expanding.
They do not believe they have found the ceiling.
Not even close.
So let's synthesize where we are before we move to the guidance. We have a company generating absolute record profits. They are pulling highly profitable, purely incremental revenue out of thin air through their CBI initiatives.
Yep.
They are deeply embedded in structural growth trends like semiconductors and electric vehicles. And they have successfully navigated a brutal raw material inflation cycle, setting themselves up for 40% incremental margins.
That is the summary of the quarter, yes.
This is the perfect pivot point to look at what comes next. Having established how resilient the Q2 numbers were, we need to examine what management expects for the rest of 2026.
And this is where the confidence of the management team really shines through. They didn't just maintain their previous estimates, they actively raised the bar.
They raised guidance.
They did. Management raised their full-year organic growth expectations by 1.5 percentage points, bringing it to a new midpoint of 3.5%.
In the context of a cautious global macroeconomic environment where, many companies are quietly lowering guidance or issuing warnings about consumer softness, raising organic growth targets halfway through the year is a massive leap in confidence.
It really separates them from the pack. Furthermore, they bumped up their GAAP EPS guidance by 15 cents to a new midpoint of $11.45.
Which represents a 9% year-over-year growth rate in earnings per share.
And it's worth noting, this is actually their second guidance increase of the year.
So they are consistently under-promising and over-delivering to Wall Street.
Exactly. But you and I both know that corporate management teams are professional optimists.
Oh, absolutely. They can get on these quarterly earnings calls, read a carefully scripted statement, and spin a phenomenal story about the future. Talk is incredibly cheap.
But actions speak volumes. And buried in this transcript is a massive multi-million-dollar confidence indicator that you need to be paying close attention to.
You are referring to the share repurchases.
I am.
Exactly. During Q2, ITW didn't just stick to their standard financial script. They opportunistically pulled forward their planned Q3 share repurchases.
They went into the open market and bought back $750 million worth of their own stock.
At what price?
At an average price of $255 per share.
To put that in perspective, $750 million is roughly 1% of all their outstanding shares, permanently retired from the market in a single 3-month window.
Let's talk about the psychology of a massive share buyback. Because when management buys back $750 million of their own stock earlier than they originally communicated to Wall Street, it is the ultimate signal to the market.
It tells you that the executive team, the people who have real-time access to the order books, the supply chain data, and the margin metrics that the rest of the world won't see for months, looked at their stock trading at $255, looked at their internal projections for that 40% incremental margin, and decided the market was totally mispricing their equity.
They concluded that the absolute best return on investment for their excess cash wasn't building another factory or hoarding it in treasury.
It was buying their own stock.
They are essentially placing a $750 million bet on themselves.
And management confirmed they plan to buy back a total of $1.5 billion for the full year. This is a massive green light for investors. It proves just how incredibly cash generative this business is.
And the cash flow metrics validate that entirely. Free cash flow actually increased by 41% in the quarter.
41%?
Yes, and they achieved a 77% free cash flow conversion rate.
Which means they are generating so much excess cash that they can comfortably fund all their daily operations, pay out a very healthy dividend to their shareholders, aggressively invest in R&D for their CBI initiatives, build new factory capacity, and still have $750 million lying around in a single quarter to just snap up their own stock.
It is a fortress balance sheet.
And you mentioned investing in factory capacity, which brings up another critical element of their operational strategy that was discussed during the guidance portion of the call.
Right, the capacity constraints question.
Yes, an analyst noted that order growth is significantly outpacing revenue growth in heavy segments like welding and test and measurement. The analyst's question was essentially, are you going to run out of factory space to build these products?
Right, how are you managing capacity constraints?
It's the classic bottleneck problem. You have all the demand in the world, but if your factories are running at 100% utilization, you can't fulfill the orders. Lead times stretch out, and customers inevitably go to your competitors.
But the CEO explained that avoiding those bottlenecks is actually a natural outcome of their 80-20 model.
Because they are constantly pruning the inefficient product lines.
Exactly. Because of that pruning, they're organically freeing up floor space and manufacturing capacity on a continuous basis. But beyond that, they aggressively balance and add new capacity in advance of the growth cycle.
They anticipate the curve rather than reacting to it.
Yes. For example, during the severe semiconductor down cycle over the last 2 years, when most companies were slashing budgets and halting expansion, ITW invested heavily in their electronic and semiconductor testing capacity.
So they built the infrastructure when the industry was quiet and cheap.
Exactly. Now that the semiconductor industry is violently ramping back up due to the AI boom, ITW is perfectly positioned. They have the advanced capacity sitting there, ready to capture that surging demand without bottlenecking or scrambling to build new facilities.
That is the difference between reactionary management and truly strategic management. And speaking of physical facilities, let me jump in with a real-world detail from the call that beautifully illustrates their operational resilience.
Oh, storm in Wisconsin.
Yes. The CFO casually mentioned during his prepared remarks that just a day or two before this earnings call, a severe storm system moved through Appleton, Wisconsin.
Right, the roof damage incident.
Exactly. The storm actually damaged 2 of their major welding facilities in Appleton. One was a core manufacturing plant, and the other was a primary distribution warehouse.
Think about the context here. We just established that the welding segment is their hottest division, growing at 14% organically.
With an order book expanding even faster. And Appleton, Wisconsin is basically the nerve center for that entire division.
For a lot of publicly traded manufacturing companies, a natural disaster hitting the core production hub of your best performing segment right before an earnings call would be a massive crisis.
It would be the primary focus of the entire call. An excuse to lower full-year guidance, or at least a reason to issue a massive warning about upcoming supply chain disruptions.
But listen to how ITW handled it. They confirmed immediately that all employees were safe, which is obviously always the priority.
Of course.
But then they stated point blank that contingency plans were immediately executed. Production was being rerouted to other facilities within their decentralized network, and they expect this major disruption to have zero material impact on their financial guidance for the quarter or the year.
Zero impact.
It is a stunning display of a robust, deeply resilient operational structure. When your supply chain and manufacturing footprint are that flexible, it neutralizes external shocks that would literally cripple a lesser competitor.
It's the ultimate stress test of the 80-20 model, really. Because they aren't bogged down manufacturing thousands of low-margin custom SKUs for minor clients, their production lines are streamlined and agile.
Right, they can just pick up the production of their core vital products and shift them to another facility almost overnight.
And that extreme discipline extends directly into their mergers and acquisitions, or M&A strategy too. Towards the end of the call, an analyst asked if ITW was looking to deploy some of that massive free cash flow to buy up other companies.
Perhaps taking advantage of slightly lower valuations in the industrial sector right now.
Right. With the balance sheet that clean, they could easily go on a shopping spree.
They could, but the CEO's response was very telling. He described their M&A posture as active, but highly disciplined.
They have zero interest in buying a company just to artificially inflate their top-line revenue and make the corporation look bigger on paper.
Right. They aren't empire building for the sake of ego. They are only interested in acquisitions that inherently possess high-quality growth attributes, strong intellectual property, and crucial market positioning.
But more importantly, the target company must be a candidate that can be significantly improved by applying ITW's proprietary 80-20 margin playbook.
They want a messy company with great core products so they can go in, prune the oak tree, and double the profit margins.
Yes. They pointed to their acquisition of MTS in the test and measurement space a few years ago as the absolute gold standard for this.
They bought a company with great underlying technology, aggressively applied the 80-20 framework to streamline their operations, integrated them into the ITW ecosystem, and dramatically expanded their margins.
But the underlying truth of their M&A strategy right now really comes back to CBI.
Why would ITW take on the massive integration risks, the cultural clashes, and the premium price tags associated with acquiring a mediocre company?
Especially when their own internal customer-backed innovation engine is organically generating 3% growth at incredibly high 26% margins.
The opportunity cost is just too high. A bad acquisition distracts management, dilutes margins, and consumes capital.
When your core organic engine is running this efficiently, your hurdle rate for an acquisition is just astronomical. The best use of capital is funding your own R&D and buying back your own stock.
Okay.
All right, we have ripped through the entire landscape of this earnings call. We have dissected the 4.5% organic growth, the record 26.7% operating margins, the 80-20 pruning strategy, the CBI growth engine, the temporary price-cost inflation lag, and the incredibly confident guidance and buyback strategy.
We covered a lot of ground.
We did. But this is where we need to synthesize all of this data. We are transitioning to our bottom line. This is where we move from analyzing management's corporate outlook to providing a direct, actionable, and opinionated takeaway for you, the retail investor listening right now.
Looking at the totality of this transcript, I will take a firm, highly bullish position on ITW.
Okay. Bullish. Tell me why.
What we have here is a highly defensive, incredibly resilient, cash-generating machine that is simultaneously exposed to the highest growth technological sectors on the planet.
It's a rare combination.
It is. When you evaluate the mechanics of what is poised to happen in the back half of the year, the setup is just incredibly compelling. The inflationary pressures on crude and resins that cause that 40 basis point margin lag are cooling off.
And the price hikes they initiated months ago are finally catching up to the customer invoices.
The jaws are opening. The input costs are dropping while the selling prices are rising. This means we are going to see those 40% incremental margins start to show up forcefully on the income statement in Q3 and Q4.
When you couple that powerful pricing dynamic with a highly disciplined 80/20 business model that relentlessly focuses on streamlining operations, you are looking at a premium industrial stock that is firing on every single cylinder entirely under its own power.
So let's break this down into actionable advice for your portfolio. If you currently hold ITW, the data in this transcript screams that this is a firm hold or even an opportunity to add to your position on any broader market pullbacks.
Management's early aggressive move to buy back $750 million worth of stock at $255 a share is your definitive green light.
They are actively creating a floor under the stock price, and they're mathematically boosting your ownership percentage of the company's future earnings without you having to lift a finger or spend a dime.
And if you are currently on the sidelines, considering initiating a new position in this stock, the metric you must watch moving forward is that CBI innovation number.
As long as ITW can maintain that 3% purely new, cannibalization-free organic growth driven by R&D, they easily justify whatever premium valuation multiple the marketplace is on them.
They are proving with hard data that they can organically invent their way to growth through challenging macroeconomic environments rather than relying on debt-fueled acquisitions.
Exactly.
But before we wrap up this masterclass, I want to leave you with one final provocative thought that we've been weaving through this analysis today.
The stealth tech angle.
Yes. The general market thinks of ITW as a traditional 100-year-old, boring Midwestern industrial conglomerate. They make welding gear, they make industrial dishwashers, they make fasteners.
That's the public perception.
But the transcript revealed a reality hiding in plain sight. Global electric vehicle production is now almost 20% of the entire automotive market. And ITW explicitly noted this macro shift is driving massive, sustained growth in their Chinese divisions.
Because they are deeply penetrated at a molecular level with the local Chinese EV manufacturers providing the complex thermal polymers that make those vehicles possible.
Furthermore, they experienced a massive 21% organic surge in their electronics segment, a surge that is completely fueled by providing the vital zero-fail testing infrastructure for the semiconductor and microchip fabrication industry.
So here is the puzzle for you to mull over as you look at your portfolio. As the global economy aggressively transitions to electric vehicles, artificial intelligence, and advanced semiconductor computing, the direct tech companies and the automotive OEMs are incredibly volatile, high-risk investments.
They are fighting brutal price wars, facing massive regulatory hurdles and burning billions in capital.
But are boring traditional industrial companies like ITW, the companies who provide the essential testing equipment, the specialized thermal polymers, and the unglamorous but vital components for these modern technologies actually becoming the ultimate backdoor, lower-risk tech and EV plays for savvy retail investors.
You don't have to pick the winner of the EV race if you sell the specialized glue to all the competitors.
But it is a phenomenal framework, and it entirely changes the lens through which you should view the modern industrial sector.
Right.
They are no longer just bending metal, they are enabling the technological frontier.
We started this deep dive talking about pruning an oak tree to maximize its yield. It turns out ITW hasn't just pruned their tree, they've genetically modified the roots to drink from the fastest flowing technological rivers in the global economy. Thank you for joining us on this exhaustive journey into the mechanics of Illinois Tool Works. Keep your eyes on those organic growth numbers, watch that CBI metric, and we will see you on the next deep dive.